Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it, and basically we are discussing over a Banking Regulation Act 1949, right? That's what we are discussing so far. Okay, and basically in the previous lecture we had discussed over a major event which is known as the audit and inspection provision, right? We had finished this provision and we had discussed it in detail. I hope that you have revised the lecture carefully before you have come for this lecture. All right? Because as I have told you, this is for your own benefit. So basically, in this lecture, we are going to start with a regulation of reserve requirement provision. Okay? It is also an important provision. That's what we are going to discuss. Okay? So basically, if we talk about this as an overview before we start the actual lecture, the question should be what is the reserve, all right, and why do we require to maintain it? Required to maintain it. Okay, that is the question should arrive in our mind before we start this lecture in the actual way. All right, so let's take an overview. All right, suppose this is the bank named XYZ. All right, so what is the basic function of bank? There are two basic functions of the bank. The first function is that accept deposit. Okay, it means that the persons who have the excess amount of money and they want to save it, so they could reach the bank, they could deposit their money with the bank, and then they will receive the interest. Okay, deposit money and receive interest. All right, that is the prime function of the bank. Second prime function is lending loans. It means that the person who are suffering a shortage of the money, or you can say who required a money for some purpose, they could go to the bank, they could take a loan from it, and then bank received interest on loan. That's the two prime functions. And then comes the function like purchasing government securities, like making investments, like financing trade. All these are the secondary prime functions. But the main two functions are this. All right. And also we had discussed about it as the income of the bank. It means that suppose on saving account, if the bank is providing 4% interest, so on loans, they will be charging 8% interest. All right. So the excess 4% will be the bank's income. This is the very basic thing which we had discussed already. All right. Now, let's try to figure it out. Okay. Suppose the bank had total deposit of rupees 10 lakhs. Okay. And remember the point which I had told you in the very starting of this particular series, which was the famous quote. And you can say the quote was basically generated by me. Okay. So the quote was, bank is, or you can say no one is more greedy than bank. More greedy than bank. Okay. It means that if the bank having a 10 lakh rupees as a deposit and they are giving 4% interest on it to the depositors, so the bank will try to lend out rupees 10 lakh as a loan and earn 8% interest from the loan takers. Okay, but here comes the problem of net demand and time liability. Net demand and time liability. Basically, in short, you can say this indicates towards the loan takers ratio and the depositors ratio. Okay, it means that suppose during the month of January to March, total duration was 3 months. Okay, the bank had lended out entire 10 lakh rupees as a loan. Okay, at 8% per month. All right, but in the meanwhile of January to March, some depositors who had deposited their money with the XYZ visited the bank to withdraw their money. Now, the question is, will the bank be able to repay the amount? No. Why? Because they had lended out entire amount as a loan. The amount which they received after 3 months. And there is no guarantee that the entire amount will be received by them. Because there could be the case of default. In short, we called it non-performing asset. Right? So in such a case, the depositor's protection is at stake. This person who had deposited their money will be now cautioned whether they will be able to get their money back or not. All right. That's why the Supreme Banking Regulation Authority, which we call the Reserve Bank of India, ensures that the bank should not lend out the entire amount as a loan or making investment or whatever the credit activities they are doing. Okay, that's why the Reserve Bank of India told them to maintain the reserve under NDTL, which stands for the net demand and time liability. All right. So now I hope you have got a little bit understanding what do you mean by reserve. All right. So suppose if the XYZ had a reserve for rupees 10 lakhs. Okay. So they could not lend out the entire 10 lakh rupees as a loan. They have to maintain a certain cash as a reserve, which means suppose 4 lakhs is the reserved. Okay, so the total amount ready to lend out is only 6 lakhs. Okay, that's how the bank could manage the customers as a loan takers or as a depositor. All right. So now I hope you have got a little bit idea about the regulation of reserves requirement and why this is very, very important. Okay. Now let's start. What are the reserves? What are the types of reserves you can say? And what are the provisions related with them? So the first is the cash reserve ratio. Okay. The CRR is the proportion of a bank's total deposits that must be held as cash reserve with the Reserve Bank of India, issued to manage liquidity in the banking system. The RBI has the authority to adjust the CRR percentage to influence the money supply and control inflation and manage overall economic conditions. Okay, so basically, CRR is the cash reserve which the banks are required to place with the RBI. Okay, for example, this is the XYZ. Okay. They had the deposit of rupees 10 lakh. All right. So basically, right now the CRR is 20% as per the Reserve Bank of India's guideline. All right. Be aware that it is just only an example. It is not the actual figure. Okay. I'm just giving it to explain you the concept. All right. So the 20% of 10 lakh of rupees, 2 lakhs. Okay. So this 2 lakhs is the basic CRR which has to be placed with the Reserve Bank of India. Okay. So it means that 10 minus 2, only 8 lakhs will be available with the bank for lending out activities. All right. And if we basically talk about the particular range of the CRR, then it is totally depend upon the current situation of the economy. Okay. It means that the limit or range of CRR is decided by the RBI on current situation. Okay, whatsoever is the prevailed condition basically decides the RBI, decides the CRR. Okay, and its general range is between 0 to 4%. Okay, all right. And remember, it is just a general range. There is nothing like a mandatory range. Okay, it could be increased, it could be decreased, but it will never be a 0 or negative than the 0. All right. And basically, the Reserve Bank of India increase or decrease it for maintenance of the economic condition, or you can say to check out the inflation and deflation. Okay, so basically if we talk about in detail how the CRR will affect these two terms. Okay, so let's start. The first term is the inflation. Inflation in the basic definition is rise in general price level of goods and services during a certain period of time. Right? This is the inflation. And basically, inflation often occurs by the increase in money supply in the economy. All right. That is the sole reason, or not sole, but one of the major reason behind the inflation. All right. So suppose if there is a increase in the money supply, it means that the purchasing power of the people will increase. Purchasing power of people will increase. And when this will happen, there will be a increase in demand. Right? And what we have learned, if there is an increase in demand, there will be an increase in price. That's what we had discussed already. Okay. So it means that when the demand will rise up, the price will rise up, and that's what the inflation. Okay. So now here comes the CRR in the picture. Okay. So suppose if the CRR right now is 20%. It's just an example. Okay. So it means that 10 lakhs was the total deposit the bank will had. 2 lakhs is to be placed with Reserve Bank of India as the CRR. So the remaining amount will be 8 lakh rupees. Okay, so it means that the bank could lend out 8 lakhs as a loan. All right, but now there is a condition of inflation. It means that we have to cut the money supply which is circulating in the economy. It means that we have to reduce the loan granting capacity of the bank. Because banks are the one of the major source of infusing the money supply in the economy. All right, so how we could do it? If we raise this CRR ratio, it means that from 20% to 40%. Now it means that out of 10 lakhs, the bank has to place 4 lakhs as a CRR with the Reserve Bank of India. All right, it means that instead of 8 lakhs, now only 6 lakhs could be granted as a loan. Okay, so we can say the loan granting capacity of the bank is reduced from 8 to the 6, and this will ultimately lead to the cutting of the money supply in the economy. All right, I hope that you have understood the concept. Now come to the next point, which is the deflation. How the deflation is being checked by the CRR. Okay, so if we go by the general definition of the deflation, all right. So basically, it is a downfall in the general price level of the goods and services in the economy during a certain period of time. Okay, it is basically a downfall in the general price level of the goods and services in the economy during a certain period of time, and basically it occurs due to shortage of money supply in the economy. Okay, we will have a more detailed discussion over the inflation and deflation in the upcoming lectures. Till then, I'm just trying to give you the overview. Okay, and this will eventually leads to the downfall of purchasing power of the people. All right, which means that the demand of the goods and services will be fall down, and when the demand fall down, the price eventually falls down. Okay, this is called the condition of deflation. Then how the CRR counters the deflation situation. All right, in such a scenario, we have to enhance the loan granting powers of the banks, or you can say we have to enhance the loan granting capacity of the banks. All right, for example, suppose previously the CRR was 40%. 10 lakhs is a total deposit. 40% means 4 lakhs is the reserved. All right, but now if the CRR reduced to 20%, it means that 2 lakhs is a reserved. All right, so in the previous example, the bank could only lend out rupees 6 lakhs as a loan, but after the downfall, the bank could lend out rupees 8 lakhs as a loan. It means that there is a enhancement in loan granting capacity of the banks. All right. So the bank could lend out more and more loans, and you can say they could be able to infuse more and more money supply in the economy, which will eventually leads up to the rise in the purchasing power of people. Okay. And eventually the demand will rise up, leads to the increase in price as well. Okay. So that's how the CRR works for the deflation and inflation. And that's why the Reserve Bank of India has the authority to adjust the CRR percentage to influence the money supply, control inflation, and manage overall economic conditions. All right. Now let's move forward. The second reserve we have is the statutory liquidity ratio. SLR, in short, requires banks to maintain a specific percentage of their net demand and time liabilities in highly liquid assets, primarily government securities. SLR serves as a secondary reserve requirement and contributes to the bank's liquidity management and financial stability. All right. So basically, by general definition, we could say SLR is the reserve requirement prescribed by the RBI and the bank has to maintain it with itself. Okay, so SLR is also a reserve, but unlike the CRR, whether the bank has to place the reserve with the Reserve Bank of India, the bank could have a reserve with itself. Okay, and basically they could purchase the government securities and other liquid assets. Okay, so this is the SLR. Now, how the SLR works? Let me give you an example. Suppose the bank has rupees 100 lakhs as a deposit. Okay, so the first reserve the bank has to lend out is the CRR. Okay, and suppose the CRR right now is at 10%. Okay, it means that the 10% of the 100 lakhs is rupees 10 lakhs. Rupees 10 lakhs is basically the CRR which the bank is required to place with the Reserve Bank of India. All right. Thereafter, the remaining amount is rupees 90 lakhs. Okay, because a CRR of 10 lakh rupees has been deducted. Thereafter comes the SLR. All right. So suppose the SLR is the 20%. Okay, it means that 18 lakhs should be kept as a SLR with the bank itself. All right. Thereafter, the remaining amount is only 90 minus 18, 72, right? So right now, the bank has rupees 72 lakhs left with them for loans and other activities. All right. So that's how the SLR and the CRR works. Got it? Okay. And like the CRR norms, the RBI still has the authority to adjust the SLR as per the current situation. Okay, it means that like the CRR, the SLR percentage could be increased or decreased by the RBI as per the given condition. It means that during the inflation time, what will happen? We have to cut the money supply. So we will try to curb the bank's loan capacity power. So what we will do? We will increase the SLR. Alright. Similarly, during the deflation, when we have to increase the bank's loan granting power, then what we will do? We will decrease the SLR. Alright. So the bank could grant more and more money as a loan. Alright. Now let's move forward. Thereafter, we have the prescribed assets for the SLR. The assets eligible for meeting SLR requirements are specified by the RBI. Typically, government securities, bond, and specific types of liquid assets are prescribed. Okay. So like the CRR, when the certain cash amount is to be submitted with the RBI. In the SLR formation, instead of maintaining cash amount, the bank could buy liquid assets. Alright, so this is the condition. In the CRR, a certain cash amount has to be submitted with the RBI, but in SLR, instead of maintaining the cash amount, the bank could buy liquid assets. Let's understand it by the example. Suppose rupees 100 lakhs is the total deposit amount the bank has, right? So the CRR was rupees 10 lakh. Alright, and the SLR was rupees 18 lakhs as 10%, as 20%. The calculation we had already seen in the previous slides. Okay, so in the first condition, the bank has to place 10 lakhs with the RBI. Okay, in the second situation, instead of keep 18 lakhs as a cash amount, okay, the bank could buy the liquid assets. Liquid assets. Okay, which means rupees 18 lakhs could be used to buy the assets, but the liquid assets. Now, what is the difference between the assets and the liquid assets? What is the difference between them? Assets and the liquid assets. If we talk about the assets, then they could be anything which could be used as a capital, but can't be converted into money quickly. All right, this is the assets. Liquid assets is anything which could be use as a capital and could be converted into cash instantly or quickly. This is the basic difference. All right. The asset could be anything, like a land, like a property, like a machinery. Okay. But can you convert the thing into the money as soon as possible or immediately? Suppose this is the bank called XYZ. They had a land of rupees 40 lakhs. Then this is the asset. Okay. But if they had a government security of rupees 40 lakhs, then it is a liquid asset. Okay. Because the land could not be sold out immediately and receive 40 lakhs. But the government security could be sold back to the government on the requirement or after the completion of the time. And the rupees 40 lakh will be given to the bank immediately. Okay. That's why, because of the quick conversion, due to the quick conversion, or we can say due to the fast conversion of the asset into cash, only liquid assets are preferred in the SLR because they could be converted into the money immediately. All right. So typically these are the government securities, bond, and the specific types of liquid assets prescribed by the RBI, which could be converted into the money fastly or quickly. The choice of these assets ensure that the banks maintain a level of liquidity and invest in instruments that are safe and easily marketable. It means that if the bank wants to convert the SLR, or you can say wants to buy the asset from the SLR, then they could not buy the land, for example, because land is a fixed asset and that could not be converted into money easily. But they could buy the government security because this is the liquid asset and could be converted into the money easily. All right. Thereafter, the changes in the CRR and the SLR. The RBI can modify the CRR and the SLR percentages to address various economic factors such as inflation, liquidity needs, or the economic stability, as we had taken example already. Adjustment in these ratios have a direct impact of the money supply and credit ability within the banking system because, as I have told you, increase or decrease in the CRR and the SLR directly reduce the bank's loan granting capacity, or we can say increase the bank's loan granting capacity. Okay. And as we had discussed in the starting of the lecture, that the loans is basically the main asset of the bank from which they earn. All right. Thereafter, the consequences of the non-compliance. What if a certain bank is not following these regulations? The banks are legally required to maintain the stipulated CRR and the SLR levels. Failure to do so can result in the financial penalties and the regulatory actions. Because the banking license, which is the, you can say, permit to any bank to operate in Indian territory or even the outside of the Indian territory with the permission of the Reserve Bank of India, is coming from the BRA Act 1949. Okay. And the same provisions on which we are discussing right now comes from the same act. It means that the banks are legally bounded to follow these CRR and the SLR requirements. If they are not doing it, then they have to bear it either from the financial penalties or from the regulatory actions. Non-compliance can affect the bank's liquidity, limits its lending capacity, and harms its financial health. Okay, it means that either their deposited amount could be hampered, their lending capacity could be restricted, and eventually their financial health will be revoked. Maintenance of the separate accounts. Banks are obligated to maintain the separate accounts for CRR and the SLR to demonstrate compliance with those requirements. These accounts are subject to regular inspection by the Reserve Bank of India to verify adherence to the prescribed ratios. Alright, so it means that the CRR account will be separate from the SLR account. Why? Let me give an example. If we take the 100 lakhs as a deposited amount, it means that CRR should be rupees 10 lakhs, SLR should be rupees 18 lakhs. Okay, so broadly, only rupees 72 lakhs will be left with the bank for their operations after deducting the reserves. But what happened? Suppose the bank only maintaining the one. It means that they said the CRR should be 12 lakhs. Okay, and the SLR is only 6 lakhs. If you merge them, still the amount will be all right 28 lakhs should be deducted. Okay, so they said this should be 20 lakhs and this should be 8 lakhs. So if you merge them, still you will get the same amount of 28 lakhs, which means that 72 lakhs should be available with the bank as they were already. But the question is this is happening as per the RBI requirement? The answer is no. Big no. Why? Because as per the guidelines, the CRR should be 10 lakhs and the SLR should be 18 lakhs. But this could be only seen if the separate accounts are being maintained by the banks. But instead of maintaining the separate accounts, the bank is maintaining the combined account of SLR and the CRR. Then they could easily say that the 28 lakhs has been taken as a reserved. Okay, and until or unless the amount is seen separately, we won't be able to find out how the 28 lakhs rupees will obtain. Like in the previous example, we had clearly seen 10 lakhs, 80 lakhs. We had found 20 lakhs and 8 lakhs. Then we will come to know that this is not doing as per the requirements. But if the combined account is showing to us, we won't be able to grasp the facts, right? That's why maintenance of separate accounts is prescribed, and the Reserve Bank of India do a regular inspection to verify the adherence to the prescribed ratios. Regulatory oversight and the reporting. The RBI exercises strict oversight of banks' compliance with the CRR and the SLR ratios through regular inspections and the reportings. Banks must submit their periodic reports detailing their adherence to these ratios. Any deviations must be explained and corrected promptly, which means if the CRR should be 10 lakhs and the SLR should be 18 lakhs, all right, and RBI found that the CRR is 8 lakhs and the SLR is 20 lakhs. Thereafter, the RBI will not consider that the prescribed amount was 28 lakhs and now we have 28 lakhs. So there is no problem. The RBI won't consider it. They will ask you, if this should be done, then why the deviation is this? So the bank has to explain this to the Reserve Bank of India. All right. Thereafter, the liquidity management. Compliance with the CRR and the SLR ratios is central to effective liquidity management by the banks. These requirements ensure that the banks maintain a balance between deposit inflows and the outflows. Like I had told you, if the bank is XYZ and during the month of Jan to March, they had lent out their entire deposited amount as a loan. So they won't be able to address the withdrawal requirements of their depositors because they didn't get the amount back so far. Okay, that's why for maintaining the liquidity and to protect the interest of both, means the creditors and the depositors, it is required to compliance with the CRR and the SLR. Okay, banks need to manage their liquidity position strategically to meet customers' demands while adhering to these regulatory ratios. Okay, it means that the bank has to maintain their liquidity positions and also address the customer demands and also maintain the regulatory ratios. All right. Impact on the monetary policy. Basically, the monetary policy deals with the money flow or money circulation in the economy. Money flow or the money circulation in the economy. And as we have already seen, the CRR and the SLR could impact the money supply by increasing or decreasing it. So that's why they impact the monetary policy. The CRR and the SLR adjustments are integral tools for the RBI to implement the monetary policy. Lowering CRR and SLR ratios increases liquidity into the banking system, stimulating lending and economic growth. Raising their ratios absorbs liquidity, helping to control inflation and maintain financial stability. That's what we had already discussed. Okay, so the comprehensive regulation of reserve requirements in the Banking Regulation Act 1949 is crucial for the management of liquidity in the banking system, influencing monetary policy, ensuring that banks maintain adequate reserves to meet depositors' demands and uphold the overall integrity and stability of the financial system. So students, in this lecture, we have finished the reserve requirements provisions under the BRA 1949. Okay. In the next lecture, we will start with another important provision. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the another lecture. With this note, let's end this lecture and thank you.